Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 21st of August. I'm Daniel Lam, your host for the podcast. I remember when I was representing Hong Kong, China in chess at the Asian Games last October, that we were shocked to hear about the breakout in the conflict in the Middle East. Sadly, that is still going on, as is the case for Russia and Ukraine, and there have been signs of escalations of these geopolitical tensions. Now, these events should be raising the possibility of a supply risk for oil and an increase in the geopolitical risk premium in crude prices. However, oil prices have been unperturbed and is pretty much flat for the year. Well, this is because of the tug-of-war between bullish supply-side risk versus bearish demand-side concerns. So all demand concerns have imposed a ceiling on prices, effectively preventing them from breaking out of their trading range. On a global level, the pace of oil consumption growth has softened very much so far this year, with demand contracting in OECD and slowing down in non-OECD. And this trend is likely to continue. It is worth noting that the contraction in Chinese oil imports is deepening as the country's oil consumption has rolled over. Soft oil demand growth raises the likelihood that OPEC Plus will back down from its plan to begin unwinding some of its production cuts in October this year. However, any such reaction would be seen as, quote-unquote, a sign of weakness from OPEC+. So since 2006, OPEC crude oil production has lagged global oil demand by 2 months on average. So this shows that rather than attempting to get ahead of market conditions, the coalition typically moves its production plans in response to them. So therefore, there's very likely to be limited upside for crude oil prices in the near term. And this also acts as a headwind against the energy sector. This is one of the reasons why, for example, in the Trump trades, we prefer to express it via the US major banks instead of the key energy stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.